All right, welcome to this explainer. Today, we're putting on our expert investment analyst hats to take a really deep analytical look at an absolute titan of American industry. We're going to put Union Pacific's first quarter 2026 data through, well, basically the ultimate financial stress test. And to do this properly, we aren't just looking at standard run-of-the-mill metrics. No, we're applying the legendary investing frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, right alongside some modern discounted cash flow and alternative valuation models. It's truly the most rigorous way to uncover the actual underlying value of a company.
Okay, so here's our roadmap for today. We'll start with a company snapshot, then look through the Buffett lens, move on to the Lynch lens, check out the Graham lens, dive into the DCF and alternate models, before finally bringing it all together for our synthesis and final verdict. Let's get right into it.
Section 1, the company snapshot. Let's establish our baseline facts.
So Union Pacific, they operate the absolute largest freight railroad in North America, covering 23 western states. They're currently sitting at roughly $268 per share. And honestly, despite cyclical declines in freight volumes and this massive looming potential merger with Norfolk Southern, the stock has held remarkably strong. They're supported by serious pricing power and a business model that is frankly incredibly resilient.
And speaking of resilience, this next stat brilliantly illustrates their staying power. A staggering 127 consecutive years of paying dividends. They just declared their Q2 2026 dividend of $1.38 per share. I mean, think about that for a second. Think about the economic cycles, the wars, the financial crises over the last century, and UNP has just kept on paying a dividend through every single one of them. It's wild.
Looking at their Q1 2026 SEC filing, it reveals some massive assets, with nearly $60 billion in net properties. But more importantly, they just reported $1.7 billion in net income for the quarter. So, the baseline financial condition here, it is undeniably robust.
All right, let's move to Section 2, the Buffett lens. We're talking moats and margins.
Now, as you probably know, Warren Buffett looks for durable economic moats and top-tier management. And UNP, they clearly hit the mark here. Operating in a transcontinental duopoly across 23 states gives them immense, and I mean immense, pricing power. Management is showing serious quality right now, too, delivering an industry-leading adjusted operating ratio of 59.9% and an impressive 16.3% return on invested capital at the end of 2025. Oh, and they also just posted record workforce productivity gains in Q1.
But, and there is a but here, Buffett loves to look at approximate owner earnings, which is essentially the cash flow left over after maintaining the business. While they generated a massive $2.458 billion in Q1 operating income, we absolutely have to factor in their heavy $3.3 billion capital expenditure plan for the full year. You know, railroads are incredibly capital intensive. They require constant investment in tracks, ties, and locomotive modernization, and that just eats directly into true owner earnings.
Taking all of this into account, Buffett's verdict would likely be a hold here. The business quality, the moat, the management execution, it's all undeniable. It checks almost all his boxes. But because of those heavy infrastructure costs and the current valuation, he would definitely require buying at a deeper discount. He needs to establish a wider margin of safety before initiating a new position.
Okay, on to Section 3, the Lynch lens, looking at categories and growth.
Applying Peter Lynch's framework requires us to determine the company's specific story. So, is UNP a stalwart or a slow grower? Well, given their Q1 adjusted EPS growth of 9%, up to $2.93, which was driven by core pricing gains that offset some volume declines, we are firmly categorizing it as a classic stalwart. It's a highly consistent earner with moderate growth.
However, a strict Lynch practitioner would undoubtedly throw a yellow flag at a few things here. First up, the PEG ratio, which compares the PE multiple to the growth rate. It's elevated. A PE of around 23 compared to mid-single-digit long-term growth, that just isn't a bargain. Furthermore, institutional ownership is very high, which Lynch notoriously dislikes because it means the stock is already discovered by Wall Street. And finally, the insider activity is a bit of a concern. Executive Vice President Kenny Rocker actually adopted a trading plan to sell up to 41,397 shares. Lynch loves insider buying, obviously, so insider selling of that magnitude is a negative signal.
Therefore, the Lynch verdict is also a hold. While it's a wonderfully solid stalwart with a fantastic balance sheet, that elevated PEG ratio, the high institutional presence, and the lack of insider buying confidence would keep a strict Lynch practitioner sitting firmly on the sidelines at $268.
Up next,
Section 4. The Graham Lens. We are getting into strict value investing territory now.
Benjamin Graham, the ultimate defensive investor, demands a strict, literal checklist of financial strength. So let's run UNP through his defensive investor checklist. Adequate size? Well, with $6.2 billion in Q1 revenue, it easily passes. Strong financial condition and earnings stability? Pass again. A consistent dividend record? With 127 years under their belt, it passes with flying colors. But, and this is a big but, it hits a massive wall on valuation. Graham demands moderate price-to-earnings and price-to-book multiples. And at a PE of 23 and a price-to-book around 8, UNP spectacularly fails these strict value criteria.
To truly see how Graham views the stock, let's actually run the math on his famous intrinsic value formula, taking the square root of 22.5, multiplying it by annualized earnings per share, and then multiplying by book value per share. So if we plug in current normalized EPS and an estimated book value of $32.70, the result brilliantly illustrates Graham's extreme conservatism. His formula values UNP at just $92.83. This means the stock offers a significantly negative margin of safety at the current $268 price tag. Simply put, Graham wouldn't even touch this stock unless it fell below $92.
Moving on to Section 5, DCF and alternate models. Time for some modern valuation.
Let's look at some forward estimates to see how this builds into a broader growth narrative. Wall Street actually expects normalized EPS to accelerate nicely. From an actual Q1 EPS of $2.93, analysts see growth up to $3.46 by mid-2027. Using a forward earnings multiple model and corroborating it with a dividend discount model, the TICR platform projects a massive price target of $426 by December 2030. That implies roughly an 11% annualized return.
Now, for our DCF model, we look at their really healthy 5.06% free cash flow yield. If we run a sensitivity table where we vary the weighted average cost of capital, or WACC, and the terminal growth rate, we see some highly interesting fair value implications. Using a standard 8.5% WACC and a 2.5% perpetual growth rate, the implied fair value sits right around that $270 to $290 mark. So this DCF essentially supports the current price of $268, suggesting it's fairly valued based strictly on its cash generation capabilities. Finally, Section 6, Synthesis and Final Verdict. Let's bring this all together.
Just look at the massive spread in our valuation results here. It's like a giant puzzle. Graham, looking strictly at current assets and earnings, thinks it's wildly overvalued at 92. The market, right now, currently has it priced to absolute perfection at 268. Meanwhile, those forward DCF models and alternate projections that factor in accelerating EPS and a successful merger execution, they see it running all the way up to 426.
So blending all of these distinct insights, the final verdict is a solid hold. Buffett and Lynch respects the moat and the pricing power, for sure, but they balk at the capital intensity and current valuation. Graham, well, he says sell immediately. The DCF says it's fairly valued with some nice upside if growth executes as planned. When you balance that incredible historical stability against the immediate regulatory and integration risks of the pending $85 billion Norfolk Southern merger, holding at 268 is really the most prudent play here. I'll leave you with this final, truly provocative thought. As the 12-month Surface Transportation Board regulatory clock ticks away, is this $85 billion mega merger a guaranteed track to unprecedented transcontinental growth, or is it a catalyst for a derailed valuation? I mean, think about how that single event could completely shift every single model we just reviewed. Thanks so much for joining me on this deep dive into Union Pacific.